Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday, and happy Friday to you guys. It's June 29th here. We're end of the quarter and middle of the year. Uh, we got a lot of economic news to go over, so we're just going to kind of jump right into it today. We got the personal income for the month of May. So in April, income went up 0.3%. We all like seeing our income going up. Forecast for May was 0.4%, and it came right at expectation. So good news right there. People are making more money. However, we had the consumer spending side of things. So in April, it went up a lot, 0.6%. Forecast was supposed to dip down a little bit to 0.4%, and it came in a little bit less expensive, a little less spending in month of May here. So obviously, April they spent a lot of money, but April and May they pulled back a little bit here. Now, here's a big one for this week here. This is called the Personal Consumption Expenditure, also known as the PCE. The reason why this is important is primarily because this is the Fed's favorite gauge for inflation. This is what the Fed looks at when they're, especially when they're looking at raising interest rates. We'll touch on a few parts of this in a minute here, but as you can see here, we had a 0.2% increase in the month of April. Forecast was supposed to be 0.2% for May, and it came in at 0.2%. Now, the year over year on this went from 2% to 2.3%. This is what we call our headline number because what the Fed really looks at is this here, the core inflation. And what the core inflation is the PCE. When you strip out food and energy, it has, which are variables that can greatly impact the numbers here, and they have no control over it. They like to have more control, so they'll take those numbers out and give us what they call the core inflation. And this is what they will use in determining raising or lowering rates here. So in April, it also went up 2.2%. In May, forecast 0.2% and came in right expectations. So what does this mean? We had a 1.8% year over year on our core inflation. It just jumped up to 2% now at this point. The Fed's target rate was 2%. So what does this mean? Well, this means that the Fed is most likely going to continue raising interest rates to keep it in that range here because it doesn't want to get overheated and keep going up. So with these rate hikes, the reason why they do rate hikes is to kind of slow the economy down so inflation doesn't get out of control. So in this scenario here, now we're at the 2% target rate. They're going to keep with the rate hike. So we're expected to see a rate hike in September, and we had a 50-50 chance before June for December, and after that last statement, it looked like most likely that's going to be greater than 50% for another rate hike. So that'll be a total of 4 rate hikes this year expected, and of course they were expecting at least 3 for next year in 2019. So those are things we're going to have to keep an eye on. But again, inflation's moving up. And why is this kind of an enemy? You want to keep it under control. 2% is a good pattern for it to kind of continue growing where it's not getting out of control. Meaning that, for example, let's say you're looking to buy an automobile. They say the automobile is $20,000. You don't want inflation to automatically take that up to equaling $40,000 in just a short period of time. Over time, yes, it's going to reach that maybe in 10, 20 years. That would be the average cost of that vehicle. But if you do it too fast, people like to be able to feel like they can afford things, and if you take things at way too high, too much of a higher percentage, it just it takes things out of control, and that's just a nice safe rate for people to allow things to continue to grow is 2%. So let's continue on here. We got a Chicago PMI for the month of June. This is a manufacturing in the Chicago region index, and we had a 62.7 back in May, and it rose to 64.1. This is important primarily because the early reports we had for manufacturing out of New York and Philadelphia, they declined. And it was just, as I mentioned at that time, we want to keep an eye on manufacturing because of all the talk with the tariffs and trade restrictions that maybe they pull back as a result of that. So we want to kind of see if that's being factored. So in Chicago's instance, it doesn't look like it affected them. And so we want to continue watching that. But again, it's a good sign for manufacturing to see Chicago going up. Now, consumer sentiment, it's a survey brought out by the University of Michigan. So they had a previous reporting at 99.3. and the forecast was supposed to be 99. It came in at 98.2, so a little bit low, but still very good numbers here. This is the final revision here, and obviously it's still a very good number here. People are still feeling pretty content, very happy about where the current state of the economy is at, and again, this is obviously still a good sign here. Headline news, stock market's up. This Dow's up actually over 277 so far this morning. Part of it is financials are leading the range because the Fed did their stress test on the banks and they all passed, which is obviously good news that if things go into a bad situation that they can hold up against us. Unlike the last credit crisis, these were tests that were brought up and some safeguards are put in place after the Dodd-Frank to try to make sure that the financial institutions don't go basically, in the toilet, so to speak. So this is so the Fed does these stress tests to make sure that they can meet up to these standards here. Also in China today, they passed a regulations that they're going to be a little less restrictive on their foreign investments coming in there. So people, corporations go in there for investments, they're going to be a little less restrictive. So that was good news to a lot of investors as well. And then not really this is going to play much of a role over here, but the EU got together and they came up after about 9 hours of meetings, came up with their migration agreement. So there's a lot of countries that were very dissatisfied with it, and a lot of people are taking on huge amounts of migration and aren't happy about it. So they were able to knock out a plan and hopefully satisfy everyone over there. So let's move on to the bond market. The bond market, typically when you have a higher PCE, like inflation data, that usually scares the bonds. We're only down about 5 basis points. This is something we're going to watch, especially today after that news, or even probably next week. We're going to want to keep an eye on that. But right now we're only down about 5 basis points, so it doesn't translate to any worse in pricing. Pricing should be pretty close to where we were yesterday. But again, it's something we want to keep an eye on, as that typically inflation scares the bonds, because what happens is that bonds set over a 30-year period, and when you have inflation spiking up, that takes away from the value of the bonds, and that usually, obviously not a very good sign. So in that respect, this is something we want to keep an eye on. And then of course next week is the Fed with the purchasing program. They're going to be kind of unloading more. As we had mentioned, just stay tuned for next week. We could see another bump in interest rates next week just due to the less demand for mortgage-backed securities and Treasuries. So again, be very cautious here at this point. So let's take a look at the Treasuries. Again, we're well below this 100-day moving average. It's got a lot of room here, so we could expect some possible whipsaws here, or you get this little head jerk reaction where it goes one direction, then within instance it goes the other direction. So just be, again, a little cautious here. It's been a pretty good run this week where you can be able to save some money by floating. Maybe even go less days locked versus full lock at 30 days. Maybe hopefully it could have gone with 15 days now. Save some money in that regards. But in any regards, be careful next week, because we start the new quarter, and as a result, typically we've seen over the last January and March, the new quarter rates have kind of jumped up, primarily because the Fed's buying less of these, so we have less demand on the markets right now. We're getting more supply into the market and less demand of purchasing it, so therefore it's kind of flooding the markets a bit, and again, that's just kind of bringing rates going up a little bit here. Okay, that's pretty much wraps everything up. If you guys want to get more updates, just come over to Twitter. You can find me at Twitter, and I post throughout the day there as well. Otherwise, enjoy the rest of your weekend. You guys have a great day, and I look forward to see you guys on Monday. Bye-bye.